I see a very young audience, and I have just one question before I start. Does anybody here feel like they're an expert in investing? If so, put your hand up. That's okay. Nobody raised their hand, and the reason why you're not an expert investor is because you didn't get taught this stuff in 8th grade, you didn't get taught this stuff in high school, you didn't see this stuff in college. All of you are experts at your own jobs. I have an MBA, I have 25 years experience running my company, I've been in business for 35, 40 years at this point. I could not do your job successfully today, maybe after a couple of years. So I'm going to take this time to walk you through the basics of investing. And I could actually talk about investing for about a semester or two, but I'm going to try and do it in about 30 minutes. And then there'll be time for questions at the end. So let's just jump right in and talk about the decision-making process. We live at the apex of human civilization, with literally trillions of bits of data available to us in our pockets at all times. But yet, this person, our caveman ancestor, is the primary driver of our decision-making process. And if that caveman was walking through the woods and heard a snap of a twig behind him, he would just run away. Because that twig could be food, it could be a mate, or it could be a tiger. And he didn't want to wait to find out which it was, he just ran. His peers that lingered to find out which it was got eaten and didn't get to reproduce. So our primary decision-making process is driven by fear, not by good sense, not by data analysis. It's driven by fear of lack of food, lack of mates, getting eaten, okay? And so when we make decisions, we make emotional decisions. Well, emotional investors are poor investors. And the way you overcome your emotional decision-making process is to apply rules. Good investors use rules to control emotions. So I'm going to spend a little bit of time talking about rules that we apply at our firm every single day with our client families to make sure that they're on the right track for their investing. First off, why do we invest at all? Anybody have an answer to that question? For the future. To convert current income into future resources. What is risk? Who here watches CNBC? Good. Nobody here watches CNBC. CNBC is an entire waste of your time because their whole mission is to get you scared to buy and sell and buy and sell and buy and sell and buy and sell. And for 99.9% of the time, the best decision in investing is to do nothing. Warren Buffett famously once said that his investment process is lethargy bordering on sloth. Risk is the chance money won't be there when you need it. It's not the volatility of day to day. It's not having the money 30 years from now. There are many risks in investing, and the number one most significant risk is your longevity, the chance that you outlive your money. Equities, bonds, cash have different characteristics. They move in different ways. Equities are the most volatile, therefore the highest returning. Cash, very low volatility, none, therefore very little return, less than inflation. And understanding the differences between equities, bonds, and cash as you go through the decades of your life is very important. We'll talk about that more. Foreign investments. We keep about 10 or 15% of our investments in overseas markets. There's advantages and disadvantages to that. Currency fluctuations. If you invest in Canada and the Canadian dollar falls 10%, well, you're down 10% on your investment. Political risk. Donald Trump may blow up the economy next year. Concentration risk. Does not apply here, but if I was presenting to an audience at Amazon, almost everybody in the room would have all their money in Amazon, which is both good news and bad news. Good news when Amazon is soaring, bad news when Amazon craters eventually. Inflation risk. If you're investing in T-bills at 1% and inflation is growing at 2%, your money is becoming 1% less valuable per year. Interest rate risk. If interest rates move up sharply, right now they're on the low side, if they move up sharply, bond prices tend to come down in value and stock prices tend to come down in value. Credit risk in bonds. US government bonds, pretty safe. Junk bonds, somewhat riskier. Preferred stock, riskier still. What does that mean exactly? Liquidity. The chance you can't get your money out when you need it. Your 401k, pretty much you can't touch that money until you're 59 and a half. Ideally, you take it out when you're 70 and a half. Any kind of investment like a variable annuity with a lockup means you can't get your money out. So you want to control liquidity. Volatility. That's the fluctuation of all these asset classes day to day. That is the risk we worry about the least. I would say that I check stock market returns about once a week on average. And I'm a guy with all of the data right in front of me. Once a week is sufficient. Let's talk about worst case returns. People generally tune into the stock market news when the market has taken a big dump. Does anyone recall that last fall, between September and December, the US stock market fell 20%? Does anybody recall that at all? One person. Two? Two people? Two people remember that. Everybody else does not, because you've got your real jobs. And also, our memories are fleeting. By March, the market had recovered all the losses of the previous quarter. This is a chart from January 1st, 2000 to December 31st, 2009. So not this decade, the past decade. We call this the decade of suck. This little green line here shows money invested into the stock market over time. And the blue line is a benchmark of stocks and bonds, and the red mark is a typical ETF portfolio, very similar to what you'll have in your Vanguard portfolios. At the end of a decade, the difference between the green line and the red line is about $100,000. That's how much money you would have made on $1 million over that whole decade. That's awful. Why would you ever do that again? Well, because decade by decade returns are variable. So this is the same chart, but now extended from the end of 2009 all the way to the present. The same $1 million is worth almost $3 million. So one of the most wonderful things that you guys have right now is the benefit of time. I don't see anybody here older than 40. You've got 20 or 30 years to let your retirement savings grow, and you'll have some good years and some bad years, but triple every 20 years, double every 10 years, that's kind of expected. So again, it's very easy to get frightened out of the market because of a 20% pullback, because you saw something on CNBC or read something in Forbes, but actually, you don't have to do that. This is how investors win at investing. This is a chart that runs all the way back to the stock market crash of 29. And obviously that was bad. The market fell 83%. The second worst market crash was in 2009. So in our lifetimes, the market fell 50%. But even so, from here to where we are now, the market is 4 times higher. I know a lot of people that jumped out of the stock market right about here and never came back in again. Those people can't retire. For every year that you have negative returns or a negative stretch, you have 9 years of positive returns. So imagine going to a casino and it was red and black, but there were 9 reds and 1 black. You'd play that game all day long. You wouldn't put all your money in, but you'd put in enough to keep getting those nice, powerful returns. One of the ways that you can control your emotions around stock market volatility is to break your assets down into different pots. And we call this purpose-based asset allocation. And generally speaking, we know that if you've got something coming up in the next 12 months, it's a tax bill, it's a house closing, it's a real estate renovation that you're doing, you can't afford to take any volatility risk. You've got to keep that safely in a checking account or a savings account. At the other end is money that you don't need for 10 years for a child's education or 30 years for your own retirement. Well, that pot can take as much risk as possible, 100% stocks. And then in between, you might have a situation coming up. Let's say you have a child going to college in 4 years. Well, yeah, you'd like to keep that money growing, but you got to make sure that tuition is there when you get there. So maybe it's half stocks and half bonds, or mostly bonds. So right now, for example, you might have your 401k invested 100% in your Vanguard stocks or your Vanguard funds, and you might have your primary checking account And you might have a secondary savings account with initially 1 month of salary saved up. And then after time, 3 months of salary saved up. And then 6 months of salary saved up. So that if something bad happens to you, you get laid off, or you get hit by a taxi or an electric scooter, and you need to be in the hospital for a while, you've got some resources. We talk about the glide path to retirement. If you fly from London to JFK, you don't arrive at Queens at 35,000 feet and then just drop onto the runway. An hour in advance, somewhere out over the North Atlantic, the pilot runs down a checklist, and the first thing they do is they call ahead to JFK to find out what the weather situation is and find out what runway they're going to be landing on. And then they call back to the cabin attendants as they prepare the passengers for landing. And then they go down a checklist. They make sure that the flaps are extended for slow speed. They make sure that the wheels are lowered, locked and lowered. We know the pilots that don't use checklists because annually 100 aircraft land with the wheels still up. That is expensive and dangerous. And it's the same thing with your retirement. Right now, most of you are over here, 25 years old, 35 years old. I think one person might be 45 in the whole room, right? Right now, you're thinking 100% stocks, maximum growth, get my money growing, doubling every 10 years. But then, as you age, you start dialing down the risk. Bonds offer a lower return, less volatility, make sure the money's there when you need it. And so it would be typical for our clients to change their asset allocation every decade from 90% stocks to 10% bonds to 80-20 to 70-30, and then in retirement they might be 65-35%. How do you actually get money in retirement? We call this the 3-bucket retirement income strategy. And the principle of it is we're going to put 60 or 70% of your assets in risk assets, stocks, international stocks, commodities. High return, some volatility. A couple times a year, we rebalance your portfolio, put the excess over into the fixed income bucket, 25%, 30%. Not as volatile, earns less. The excess of that overflows into the cash bucket, about a year's worth of income for our clients. And then every month, the client gets the exact same allowance, the exact same draw. Remember that chart I showed you of the decade of suck? Through that entire decade, the clients that were relying on their portfolios for retirement continue to get the same monthly draw. Because while from the start of the period to the end of the period, the return was 0, it was higher along the way, it was lower along the way. And so with this waterfall process, we could take the money out. In 2009, when stocks were way down, we just turned off the waterfall for a year or two, waited for the stocks to come back up again, and then continued the waterfall process. And we can do that because we always have a year's worth of income here and 4 years worth of income here. Steve mentioned that Vanguard has some pretty good technology. Our firm has some pretty good technology as well. And you might ask yourself, what is the role of the human advisor in financial planning anymore, right? Isn't there an app for this stuff? Can't you get on Betterment or Personal Capital? And the answer is, what modern clients want are the following. They want the technology. They want to be able to see their situation 24/7 on their phone. They want transparency. They want to know what the fees are. They want to know what the returns are. They want to make sure that there's nothing to ambush them. They want the information access 24/7. They want to understand the value of what they're getting involved with. Albert and Steve worked very hard to create the best possible, least expensive 401k plan for you. But most importantly, they want a person to talk to. Because if you pick up your phone and dial an Uber and have a bad experience, it's not the end of the day. If you pick up your phone and go on to Hotels Tonight and get a hotel room and have a bad experience, it's not the end of the day. If you go on your phone and click on Tinder and have a bad experience, it's not the end of the day. But if you have a bad experience with your retirement, you can't retire. So people really want to make sure that they're on target for that. So what you're going to try and do is market time. And we've studied every single market timing strategy that's ever been put out there. And they all deliver worse returns than buy and hold. If we could market time, oh my God, we would do it. But we've been saying, I was on a TV panel a few weeks ago, and there were 4 advisors on the panel, and we all had a kind of a don't feel too good about next year vibe about ourselves. Well, that doesn't mean I'm ripping money out of the stock market. What it does mean is that I wrote my clients and said, hey, listen, if you've got a big expense coming up, you're buying a house, taking a big trip, whatever, tell me now. I'm taking the money out now. Now, here's the good news if the stock market falls off sharply next year. You're in saving mode right now. So the more you can buy at low levels, the better for you. I mean, if you had a situation where you could buy for the whole decade, last decade, at low levels, and then it tripled to the decade after, that was a win as far as you were concerned. Going back to that slide of purpose-based asset allocation, if you think there's a downturn coming in, you might lose your job for whatever, make sure that in your checking account or your savings account, you have a few months reserve, put the money there, and then when the concern goes by, start putting the money back into the stock market. But we love 401k investing because it takes away the emotion of, is this a good time, is this a bad time? I don't know. It just happens automatically every month. Let me just give you a sense of compounding. Just to get to 100,000 takes forever, it seems. And then to get to 250, that wasn't so hard. And then to 500, whoa, I've got some real money. And so one of my favorite clients was 30 years old when he came to work with us, and he only had $200,000, which was actually a lot for a 30-year-old. This was 20 years ago. And between his diligent saving and our diligent investing, he has about $2 million now, over 20 years. But he also has a fully paid house in New Jersey. He also has fully paid tuition for his 2 kids. He also has a country house in Vermont, and he just bought a Porsche. So I said, what's next on your bucket list? What else do you want to get? He goes, well, I'd like another Porsche. I said, great, we'll start working on that. So that's the power of compounding over 20 years. You can remember the most simplest rule that we know, the rule of 72. If you take your rate of return, let's say it's 7%, and divide it into 72, the answer is 10, that's how many years for your money to double. If you're only getting 1%, divide that into 72, it takes 72 years for your money to double. So again, when you set up your 401ks in September, most of you should be 100% equities. And then as you get into your 40s, 50s, and 60s, you should start lowering the percentage of equities. And the actual timing of it, you work with a financial advisor to get it perfect. When is the timing of taking money out of a retirement plan? Retirement plan is a 401k for a private corporation, 403b for a charity or a school, 405, whatever it is. 457, thank you, if it's a government organization. The earliest you can take your money out is 59 and a half. You must start taking money out at 70 and a half through what's called a minimum required distribution. So when we are figuring out asset location for those retirement plans, we tend to draw money first out of taxable assets and only draw money out of the IRAs when we have to, because that enables us to keep that tax deferral going as long as possible. So 59 and a half is the earliest you can take it out. 70 and a half, you must take it out. So you're 32?
Yeah, sure. 28.
28, all right. Right now, 100% stocks. And the easiest way to do that is just by one of the target funds. That's an option, because that will automatically adjust over the decades to come. So a target fund, when you get target 2025, that's only 5 years away. That'll be half stocks, half bonds. But target 2055 will be 100% stocks. So the easiest way to do it, one decision, is just buy the target fund that corresponds to you turn 35. Once a month, once a quarter is enough. Like, I actually have tens of thousands of dollars of market data on my desk. I look at the market once a week. That's plenty. Okay. What happens day to day is almost entirely random noise. every time you pay off that college loan, you're getting a risk-free return of 6 to 8%. Well, the best we can expect from the stock market over time is about 7%. So, you might sort of split the baby and say, I'll take the commission check, I'll throw half of it into my 401k to at least get some tax deferral going, and throw the other half against my loans to reduce this horrible sucking sensation I have every month. Right? I mean, I have clients that have $300,000 in student loans and want to start a family. They can't start a family. That's not an option for them. So then, when you pay off that last loan, you immediately start throwing that extra money into your savings. And it's like people are funny. If I get, let's say, $5,000 a month salary, but I divert 1,000 of it before I even get it to my checking account, I live happily on 4,000. It's the ones that like get the 5,000, and then you go, oh, I didn't fund my IRA. Oh, but I have no money left. So we love automatic investments. We love having a simple rule. Okay, I got a check. I can split half of it to my 401k and half of it to my loans. Keep that rule going, and you'll be fine. Okay. And how long have you been working here?
This is 3 years last March.
And so are you kind of like low to mid 6 figures in income?
No,
Not yet. Okay, but heading in that direction.
getting
hopefully.
there faster.
Good.
After this year, so yeah, we'll get there.
Yeah. Well, as you move up the earnings rank, keep us in mind because our typical families are either executives, right, people 50 and older that have already made their money, or rising professionals that have high income but are still paying off those loans. And we want them in our client base sooner rather than later to optimize your situation. Are you single, married?
Single.
Okay. Do you plan to get married?
I don't know.
Yeah.
Maybe.
Okay. So the reason why I ask those questions is because single, that means one set of options. Married means another set of options. Married with children means a third set of options, right? So a lot of our planning process goes around who are you before we give you any advice. Like if you ever had a situation where you wanted to build a house and you had a meeting with the architect and the meeting starts and the architect rolls out the plans and you go, whoa, you're fired. Because you don't know anything about me. You don't know if I want a ranch or a colonial or Victorian or a 2-car garage or 3-car garage, putting green, swimming pool. You don't know anything about me. How could you be showing me plans already? And that's our approach as well. We have 175 families that we work with. Not one has the same plan as another one. It's all custom to them.